Hi, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. And today, Jeremy, the foundations of a high-performing property selection. Now, I know you wondered how I came up with this type of episode, and it starts with a video I found about 14, 15 years old of you. So let's bring it up on the screen. I know I've got you surprised here. Look at this, Jeremy Shepherd in his prime. So let's hit play.
Yeah, I know.
You remember this one? Let's have a look.
Avenues to explore. You can download my research guide on this web page, and perhaps it would be worth your while reading the article I write every month in YIP magazine, where I uncover everything about the score and how it can be used to invest.
Mate, looking good.
Just
go for that haircut.
Clarify, YIP is short for Your Investment Property Magazine.
Was that a bit of marketing I heard? You said, go to put your email address here. Was that marketing, or you were just...
I don't know.
Were you trying to market or not?
I was doing what I was told.
Oh, is it really? Is that what it was?
I can't even remember. What was it, 14 years ago?
Do you remember the video?
I do. I do remember recording it, yeah.
The hairstyle's looking good. But
Yeah.
I thought with the episode, where I'm going with this is, I think it's just good for us to just go off the cuff, have a bit of a chat about, I guess, selecting potential, I guess, maybe high-performing. I've got property selection here, but I think a lot of it will be like suburb sort of selection, but we will talk a little bit about property selection. But let's start with how can, I guess, investors minimize mistakes in there. Let's start with suburb selection first, and then we'll go to property selection. So suburb selection.
Well, that's the easy part. And you're just looking at data there. That was what I was talking about, that demand to supply ratio. That was the whole idea. Where do I buy? That's the thing that answers that question. So it's an algorithm.
Well, there's more players in the game, and everyone's going to say now they've got their own algorithm. So who do we know who's best?
Well, I'm best, obviously.
Well, I'm sure there's been markets that haven't performed.
That's true, yes.
So I've always been big on, I guess, cluster analysis, looking for areas that have high probability of growth instead of just looking at one market. So, for example, you might look at maybe a buyer's agents have their own data potentially, but what you'll see on their list is they'll have this suburb in Tasmania, this suburb in Queensland, maybe one in Victoria. It's all over the place. And what you want to see or look for is a cluster of areas when you shortlist. So don't pick those outliers out.
Yeah, if it's a one-off suburb on its own, isolated, it's the only one in the area that has a high demand to supply ratio, then I would not be confident buying there. But if its neighbour or neighbours all had decent scores as well, that just gives me more confidence there's something going on in the area there. That's what you mean by, cluster analysis.
And I guess our algorithm's been there a while. Or the algorithm that you built.
That one you just showed, that was version 1. So
version 1.
Yeah, that was back in 2010. So it's gone through some iterations since then. Yeah.
So getting more data, more consistency, and that's what we're obviously always striving for. But you can always, I guess, maybe sense check with competitors and come up with your own procedure, potentially.
You know, data at the moment is so incredibly cheap. You could buy every source you wanted to. And if you just were... You're looking at one more data source and it's just going to cost you $1,000. If it gives you 1% better capital growth over the next year, for a $500,000 property, 1% growth is $5,000. So you've spent $1,000 to be better off by $5,000 within a year. That's a better return on investment than investing in property.
Because I guess you've got a lot of costs when you are purchasing the property, legal fees, building and pests. I think data is one aspect that a lot of people overlook.
Yeah, well, the return on investment is so good, you just wouldn't want to skimp out at all on that. If I could find one data set that just improves the DSR by the slightest amount, I'd spend heaps on it.
Well, that's one aspect, suburbs. So that's like looking at one piece of information, okay? And I guess, how about property selection? So you've got that suburb selection, which is the first step. So everyone's got their own way of doing it. And that's just something that you need to work out for yourself based on what your strategy and plan is. But how about property selection? So now you're diving into that granularity of buying the actual property, which is more hands-on. And that's why a lot of people utilize a buyer's agency service, because it's tough. I don't want to be out there. I don't have time. I need an expert to hold my hand through the process. And I think it's very popular in America with the buyer's agents, but definitely these days here now, like Uber drivers, there's a lot of buyer's agents coming out of the woodworks everywhere.
Yeah, well, if you've picked the right market, then this is where a buyer's agent does come into their own, because the right kind of market, it is hard to even get a foot in the door. Agents just don't return your calls. There's so much competition. There's so much demand, so little supply. Having someone that's a professional working on your side can be an advantage.
Just finding the right person's the key.
Yeah, same as everything.
Yeah. And if anyone needs a hand, just send an email to podcast@suburbdata.com.au. A bit of a plug there. If anyone needs or just, I guess, a helping hand, if people are stuck along their journey and they're like, I don't know what to do, just reach out to that email address and we can see if we can point you in the right direction.
And just a couple of things on, if you do want to do it yourself, asset selection, like the actual property. The things I would be looking for is highest possible land to asset ratio. So you want to be spending more of your money on land in dollar terms, not in square metre terms, in dollar terms. So if it's $500,000 property, you want to be spending $400,000 of those $500,000 on land, and the building you don't want to be too significant.
Yeah, what I see a fair bit, depending on the market that you're looking at, there might be a lot of properties or listings on there that have been freshly renovated. So you're paying a premium for someone else's renovation. So if you're a borderless investor, let's say, i.e. you live in Sydney and you want to buy in, we'll just say Perth as an example, or Adelaide. You want someone to be potentially maybe a property manager that can help with like a coda pane, or talking to the property manager when you buy a property that's a little bit older to go, hey, where can we get that rental increase? Yeah. So because if you're paying a premium, let's say you're paying $100,000 more for someone else's renovation, well, you're paying more on stamp duty too, aren't you? Because you're paying a bit more of a premium. So it's like that, trying to find that sweet spot. Ideally, you want to be able to buy a property that you can rent out right away that's structurally sound.
Structurally sound, neat, but perhaps a bit dated. So you could renovate it in the future.
Because you do have that, like that suburb selection is the big one, because as we've said before, there are markets in the last 3 years that have underperformed or even gone backwards. And there's been other markets where have increased in value. So if you followed the data, well, you'd be way ahead. Even if you picked the area, threw a dart and picked any property, you still would have done well.
That's right.
And even if you overpaid at the time,
that's a good point.
You would have done really well.
Yeah. I'd rather pay above fair market value, so that 6 months from now it looks like I got a bargain, rather than pay below market value in the wrong market and 6 months later it looks like I paid too much.
What do you normally see? I got it under market value.
All the time.
Under market value. I've got the secret recipe, under market value.
Yeah, every purchase that's under market value, that is a kick in the groin to capital growth, because every other buyer sees that purchase and they think, oh, I want the same. I want an under market. And that could snowball and represent the downturn in the market. In a hot market, you put in a low ball offer and you just get ignored.
So what are the most common emotional pitfalls investors face, and how can they avoid them?
So there's a few there. Obviously, there's analysis paralysis, just a bit too scared to pull the trigger and actually purchase a property. And that can be actually a good thing until it's plagued you and 6 months has gone past and you still haven't pulled the trigger. The opposite to that is fear of missing out. And then you rush things and jump in too soon. You could pay a bit more over, but I think that's less of an issue. It's really just buying the first property that you see, thinking it's a fantastic opportunity. You don't really need to rush, even though these markets are moving. You're probably better off just exercising some caution. And another one that's a little odd, like a fear, I think there's a lot of really good markets out there that might be a lower socioeconomic demographic. They might have a higher than average crime rate. And a lot of investors are worried about buying into those sorts of markets, and so they steer clear. And there's an opportunity cost there because some of those markets can be fantastic. But that's less of a damaging fear. Like, I think it's always better to err on the side of caution. All you're missing out on there is opportunity.
I think the most common emotional pitfalls I've seen is where clients they've just made a rash decision, just bought it off the plan or done something really quickly without analysing their circumstances. And then, they've decided to start a family and they've got all this financial pressure on. They've bought an underperforming asset. Like, they've tried to rush the process. And unfortunately with property investing, you can't rush the process. But once you buy the property, it's rented, then you can sort of forget about it. It's like people do more research on a holiday. I've heard that a lot, haven't they? People do more research on a holiday than they do on their property investing journey.
It's 100 times more expensive. Yeah.
I spend a lot of time on the holiday planning spreadsheet. I've got the car spreadsheet. I've got the property. I overanalyze a little bit too much, but you need to make a decision at a point in time, and it's all experience. But I would think that the fear of missing out, like just trying to rush it, is dangerous. The other one I see is a lot of people going on social media, especially now. Maybe 5 to 10 years ago, it wasn't as prevalent, but I find now it's a lot more difficult because everyone's showing you, hey, look at my life. I've got financial freedom. Look at my recipe of success. And people think, I want to be there now. I don't want to wait. They must know what they're doing. Let's go.
The TikTok education.
TikTok and just that, they just show you what you want to see, the flash. What do we call it? The flash in front of your eyes. They just want to show you what you want to see.
Yeah.
Now, can you share an example where an investor deviated from their process and regretted it?
I can't think of myself as an investor.
Let's maybe your example. Go for it.
Okay, so one of them about finance is you don't cross-collateralise. And I thought I'd found a situation where I couldn't lose, and I was buying a few houses at the same time, and I wanted to cross-collateralise because I thought I could make a saving. But sure enough, a few years later, it was a problem for me because I wanted to sell off just one of those houses or two of them. Don't cross-collateralise.
Yeah, cross-collateralizing is when you got different securities for the same loan. Typically, that's what cross-collateralizing is. So you might have a loan, but it's secured against two different properties. You can talk to your mortgage broker about this. This isn't mortgage broking advice. But if one property goes up, one goes down, your hands are sort of tied. Where if you separate it, you've got a bit more movement, I guess. And I think having like the proper mortgage or broking structure is really important. I've seen so many people that will fund a deposit for their next investment by taking cash out of their personal offset account. So they get no tax deductibility instead of like doing an equity release first, do that, and then look at your serviceability for the next bank. But it's hard. It takes time. People don't want that. I just listened to my broker. You have to remember, your broker isn't an accountant. They're not potentially an expert in property investing. You need to talk to someone that's really educated with investing in properties. For a lot of people, they want to get the deal done, move on, let's go. If it's too difficult, brokers don't want to spend more time than they have to.
Do you know a story of an investor who deviated from a well laid out plan?
I think a lot of people don't have a process. They just go, I want to buy a property.
Yeah, well, I think that most of my regrets were the mistakes that I learnt from, and those mistakes became part of the procedure.
That's right. You learn from that. So you've got your own sort of what you've built and your own procedure on shortlisting, but everyone's got their own recipe, don't they? All the firms, everyone's got their own way of doing things. And it's all about trying to beat the national average, buy a good property, forget about it, and have a good experience that property's growing, or not having a good experience initially because has that property performed or not? You see on these posts saying, hey, we've bought a fantastic property for our client. How do you know it's fantastic? We
Yeah,
want to
it's-
see 3-4 years of growth and see if it's fantastic.
Yeah, they haven't even shown 3-4 months and they're saying it's fantastic. How do you know it's fantastic?
So I think I always say, forget about property investing initially. What's your life plan, life goal? I won't go into the whole life coach, all that type of stuff. I think for yourself personally, where are you at and where do you want to go? And it's property investing fits into that from a financial aspect. So is it going to impact your lifestyle in any way by sort of accumulating properties? And initially it does. I think a lot of people think I'll buy a property, I'll be rich overnight. It doesn't work like that.
Yeah, no, nothing like that.
But I would say, 3 to 4 years, you would hope to have significant capital growth or at least beat the benchmark. So if there's been zero capital growth over the national average over 3 years, I want to beat that. That would be a success for me.
Yeah, that's getting ahead.
Getting ahead. If it's 6% capital growth, I'm hoping to get 8, 9, 10% per annum. So they're the things I think is just people rush it. They don't have a process. They don't know what their money management's like. I think getting that in order is the first step. Then you talk to a broker and work out where you're going to go. Now, how does the demand to supply ratio differ from other property indicators?
Well, most of the indicators that you'll see published, things like median values, auction clearance rates, vacancy rates, days on market, stock on market, those sorts of things, they're very simple, raw, individual metrics. They might only be based on 2 or 3 items of raw data. So, for example, vacancy rate is based on the number of rental properties there are in the market and the number of properties that are currently for rent. So there's 3 things you need to know there in order to calculate a vacancy rate. You need to know how many properties are in the area, how many rentals are there, and then how many rentals are for rent. And then you get one metric. And because there's only a handful of data that comes together for that calculation, it could be wildly volatile from month to month. It might go up, down. One of the things about the DSR is it brings together an enormous amount of data into a single figure. So it's getting auction clearance rates, vacancy rates, stock on market percentage, days on market, the percentage discounting, the online search interest, all of those things, and brings it together into a single figure. So how it's different, I guess, is a larger volume and looking at the nature of supply and demand from multiple angles. And I guess at its core, it's trying to gauge demand relative to supply, which of course is a lead indicator.
So how do you, let's say there's a new data point that piques your interest. You've been fortuitous enough to find this new data point. How do you work out, okay, I'm going to back analyze this. Has this got any correlation to capital growth? So do you need to look at every suburb at every month with that specific data point to see if it contributes to capital growth or not, or if there's any sort of correlation?
Yeah, more or less. I mean, you don't have to look at every suburb. Some suburbs might have unreliable capital growth calculations. So the typical value for a house or unit in that particular suburb at the start of a period of time might have been unreliable. It might have only been based on 3 sales and they might not have been representative of the rest of the suburb. So first of all, you need a decent calculation of capital growth, but you also need to look at an enormous amount of history too, because you can find that this metric might have worked in a particular era and not in another. I remember years ago, this guy was showing a tight correlation to the hold period of time that properties are held typically by owners in a suburb. And they showed this striking correlation to future capital growth, but it was only looking at the last 5 years of data. And I looked at the last, I can remember it was 27 years of data. So I should be able to figure out when that was. I can't remember. It's going back almost 10 years now, I think. Maybe not 10 years. But because they were only looking at the last 5 years, they found a magical correlation that doesn't actually exist. If they'd looked at longer period of history, they would have found that there are eras when the hold period is an indicator and eras when it is not. It is the reverse. So you said you got to look at a large amount of history. That's spot on. You need to look at a wide range of suburbs, and you're backdating this to find the remotest correlation. One more thing, it's possible to find a metric that has no direct correlation to capital growth, but in combination with another metric, it may do.
And so you would add that. So are there examples where you have analysed a new metric? You're like, oh, I'll double check this. And you've gone, no, it has no correlation. I'll just put it to the side.
Yeah. There's so many other data sets to examine that if I don't see anything straight away, I've either got to have a very strong belief about it to keep looking, or I'm wasting my time. Let's just move on to the next one.
Would you revisit it? So like, let's say you looked at a metric 5 years ago and you're like, okay, I'll double check that again in another 5 years. Has there been any correlation in any way?
Yeah, in some cases there might be a data set that's quite new. The data age is still relatively new. So you might not have had enough history, but you've just got to keep acquiring, and then later on, oh, that's right, I remember we've been acquiring this data set, I might check that now.
How often should investors review the demand to supply ratio score when managing their portfolio?
Okay, so you've got a property already. You're not using the DSR to find where to buy. You're checking to see whether demand has been knocked out of the sales of that market, perhaps.
Yeah, I think that the way I look at this is maybe annually, maybe every 6 months. Like I would set a reminder every 12 months, even maybe like 6 to 9 months. You get a valuation. How's that market performing? And if you're noticing that market slow down, you might want to be active, either pull some equity out, try and buy again, or maybe liquidate that asset, maybe pay off your home if you've got your owner occupied, and then maybe go buy another investment. Like it gives you wiggle room to decide what to do, or gives you options or levers to play with. So I would think that you should check in to see, okay, well, I check the score of this suburb in a year's time, 2 years, or you might look at the local government area or the state, compare it to the other states. Like, are there better opportunities elsewhere? I think that's the way that you'd want to look at it. Maybe your property's had significant growth. Maybe it's slowed down. The score's sort of balanced now. Maybe it's time to look to offload. The difficulty there is it's a process, isn't it? When you do want to sell, you got to find a selling agent. You got to factor capital gains tax. You got to go buy another property. You got to use a buyer's agent. You got to pay stamp duty. So people are like, that's too hard. I don't want to do that.
Yeah, I can understand why some investors just want to buy, set and forget, just for the ease. But if you do want to get ahead, you do have to check regularly, and you might need to trade.
We've spoken about that, and that's something we're going to look into the future, because now I'm thinking, okay, trading's got a place somewhere in property investing. I think there's definitely a place for it, and it's not spoken about it. You hear blue chip a lot, buying a blue chip, forget about it. Who came up with the word blue chip?
I think it's from the share market.
Okay,
isn't it?
blue chip.
It's like, isn't
investment grade?
In poker, the most expensive chip is the blue one, isn't it?
I'm not sure, but then why isn't it a green chip?
Do they have green chips?
I'm not sure.
I think white chip is the opposite end of the spectrum. They're the cheapest.
The way I look at it is that, you might have 1 or 2 or 3 that you just want to set and forget. I don't want the headache. I'm just happy with the way they're performing. I've got my rental income. And then you might go, okay, well, if I can go buy without affecting these other properties, then I'll just do it. Or I might sell one and work out what my strategy is. But I think if you're working and you're in a good spot, maybe you don't need to sell. But if you want to be a bit more active and you want to move a little bit quicker, I think there's a place for trading. And I think that's something that we're going to explore more, because we have spoken a lot about it.
Yeah, that video you showed before, 14 years ago, I remember, 15 years ago, the thought of trading property was just ridiculous. You just buy and hold, because how do you know that the place that you're going to buy is actually going to have better capital growth than the place you currently own? So people didn't know then. We couldn't forecast capital growth nearly to the degree of accuracy that we can now.
And the term blue chip comes from the world of poker, where blue chips have the highest value. So you're right on that one.
I did Google it a while ago.
You don't play poker though, do you?
No, but I was curious. Where did this term come from?
Blue chip. All right. So Yeah, I think that's the key summary or takeaway there is you can just maybe check in every 6 to 12 months just to see how it's performing. Where I'd maybe definitely look at it is, let's say I've already got an existing portfolio and then I've stumbled across the DSR and I just want to check. I want to review my portfolio because you'd be surprised how many people don't work out the performance of their property. If they've seen growth, oh, I've had a great experience, I've made some money, but have you beaten the national average? If the last 10 years has been growing at 6% per annum, and let's say I've only been getting 3%, your experience hasn't been that great. So don't tell me that you've had a great time.
Yeah, some people will look at any capital growth as being a good thing, not realising that it's, the bog standard may be a lot better than what you're getting.
So I guess once a suburb is shortlisted based on data, what's the first thing investors should check on the ground?
First thing I'd look at is, does this match the price point I expected? And if so, what sort of properties are selling for around that kind of price?
So it wouldn't be just like you check out the grass, what type of cars people have, go to the coffee shop.
I would also bring up on Google Maps, I want to see how much vacant land there is around the area. If I don't know the suburb, it could be a fringe suburb and there could be some greenfield estates that will thwart capital growth with their continual supply into the future. So I want to avoid those.
I think land's most probably the big one there because you can do a lot of your analysis at home. Pretty much you can do all of it from home. So you don't really need to be on the ground. There's obviously things you most probably want to avoid, but it just comes down to your price point. Like let's say you're going into a market that's a suburb that's got a typical value of 800,000 and you've only got 700,000 to play with, not only, but let's just say 700,000 to play with, well, you might need to compromise on that property location. If all these properties are selling for 850 and you've got 700, or you go into another area where the price points or the typical value is lower, but you've got more of a budget, but it all just comes down to what your budget is and where do you go to from there. But I think it's so easy to get tied up in the whole property selection. It's really the suburb that's like number one, and a lot of people get wrong.
Yeah, once you're in the right ballpark, it's pretty easy from there. But the problem is you might have a few properties to choose from and you think, well, why would I buy this one and not the other one? Well, if you can't figure out that difference, but you're in the right suburb, it probably doesn't matter.
Well, that's a good problem to have. I think the main problem people have is
nothing.
A property comes on the market and it's gone within hours. It's like, okay, I'm not going to hear back from that agent again, am I?
That's right, yeah.
So you can sort of tell how quickly things are moving. Now, how does upcoming infrastructure developments impact long-term growth potential? Or I'd just say growth potential, not long-term, because long-term's thrown around all the time. But how does infrastructure developments impact it?
Well, I don't usually look at infrastructure because it is such a difficult thing to reliably forecast. First of all, you could have an infrastructure project that adds value to properties in the area or detracts from those values. For example, a new airport might create jobs or it could just create a lot of aircraft noise. Shopping centre could be convenient. You can walk to the shops, or there could be just traffic, bumper to bumper traffic, all at all hours. So it's very difficult to know what impact before it's built is going to be on the demand for real estate in that market. And then there can be delays. You could have a significant infrastructure project that is even cancelled. There could be a change of government. Commonwealth Games there was going to be in Victoria. So I generally ignore them. I think if the infrastructure project is going to have an impact on the demand for real estate in that area, let's wait and see how much demand it's having and in what nature, and then make a decision to buy into the market. I don't want to take the risk of getting into the market too early and then it just doesn't go, or it goes backwards because what played out was not what I had in mind.
You sort of want to get into a market when that uplift is just starting, maybe not right away because you're speculating a little bit, but maybe you're starting to see some sort of growth in a specific pocket or market, and that's when you sort of want to dive in. So if you sort of look at it as a line graph all the way sort of going up, you sort of want to try and get it on the upswing, correct? The sort of 6 to 12 months.
A lot of people think, I want to get in before the demand takes off. I want to get in there before prices take off. but that's on the assumption that they will. You don't know that they will, and you don't know when either. So if you're waiting for a delayed project to complete, that could easily blow out 1, 2, 5, 10 years. And if you aren't getting any capital growth because that project is incomplete, there's been a massive opportunity cost that you've missed buying elsewhere in the country.
I think it's a matter of when you're ready to go, you go. You've got that allocation of, let's say, 500 or 600,000 or 400 or 300 or sort of a couple of units actually in the sort of 170, 200 range. So there are low price point properties that you can purchase to get started, but it's where was I going with this?
When you're ready,
when you're ready, that's it, because you want to allocate the cash. You might not pull on it right away, like just go. You might want to wait 3 months, 6 months, educate yourself first, and then maybe look. But you want to try and get that money allocated pretty quickly, so your money's working harder for you. Now, last question for the episode. So, have you ever seen a suburb with a strong demand to supply ratio score underperform? That's my first question. Underperform.
Oh yeah, it's not perfect. There've been some failures. Most of the failures aren't that bad. When I say underperform the national growth rate, which is the benchmark of success that we put against it. And I think we're still in a phase where we're trying to perfect these algorithms, but you're never going to get it absolutely perfect. So yeah, there have been failures.
And how about due to external factors?
Sometimes due to an unknown factor. I just didn't know what happened in that market. External factors, there's all sorts of things. There could be, we were talking about infrastructure. Perhaps there was a cancellation of that project, maybe a change of government, which can happen. Or there's simply a change of federal government even, and that might just spook investors. There could be a sudden rise in interest rates, a stop in immigration. Yeah, there's loads of external factors.
I think it was an election in 2018. Was it 2018, the election? And I noticed that prices slowed down because there's a lot of talk that the Labor government would get in and negative gearing would be abolished. So I know that had, in certain areas, a bit of had an impact. So that's got nothing to do with the DSR. Would that data feed in any way at all, or not really?
It would have been feeding in leading up to the election. You would have seen a lower sentiment from investors, a smaller portion of the market that buys. But yeah, you could have seen in heavy investor areas there might have been a lack of interest.
That's it. Okay. Yeah. So that was the main thing. And maybe COVID's the other one. But as we know, there was a lot of doom and gloom. Property prices are going to crash. Oh no. But we've seen the opposite, haven't we?
Yeah, well, that one was, I guess, fueled by lower interest rates. I mean, we can only assume. There's no perfect audit trail here. We're just noticing a correlation.
I think in my time, since maybe tracking the DSR, so I was first a subscriber back in 2015, but obviously every month, the last, how many years, I like to look at everything. I like to look at it from a high level, not so much a suburb, but more estate, SUA, significant urban area, local government area, suburb, that's my checklist. I go, okay, this is my process. This is a way that I want to look at it. And, before Hobart boomed, the DSR was strong. Before Adelaide boomed, it was strong. Brisbane was slow. I remember the DSR was strong for a very long time, but it wasn't really moving. So there was a delay there. And that's one I clearly remember because I was saying, Jez, what's going on? So there was a delay in the Brisbane. I was looking at from a city level. Why was that? Why did it take so long? So the DSR was strong for a long period, but it wasn't really moving.
Well, it's not a perfect algorithm. It's the same thing. You just need to acquire more data and feed that into the algorithm and look at those specific circumstances. I don't know what the specific case was with Brisbane and why it was slow to pick up. But I do remember I thought Adelaide was a bit slow. I thought that there was some great markets there and nobody was talking about it and prices were slow to react then. But I do remember people talking up Brisbane. I think it was straight after the Sydney boom, like Sydney's boom, the one from 2012 to 2017, start of 2017, I think prices grew by about 80% in that 5-year period. So as soon as we got to 2017 and the market started to peak, level off, that's when people started talking up Brisbane. And I wasn't seeing anything in the data then about Brisbane. And the next year they were pumping up Brisbane as well. So I don't know whether maybe there was some investor-fueled activity there. I don't know. I can't answer. I would have to look at spend a week looking at data to see what the issue was.
In a perfect world, you would have bought in Hobart, had the uptick, pulled out the equity, and then most probably gone to what was it, Brisbane or Adelaide that went first? Gone into Brisbane, but then a lot of regional markets picked up, like New South Wales regional markets, Queensland regional markets. So you can sort of time it if you do it the right way. You can increase the probability of getting right, and you've got a big advantage if you can diversify. Like instead of just putting all the eggs in one basket, if one market doesn't pick up, you can shift and try and get into a secondary market potentially. But we're confident of the data and the probability. But I think with that Brisbane example, it did eventually move. It was like the pressure was there, it was taking a bit of time, pressure was there, and then it just went bang. Yeah. So it didn't go down, it went up.
Yeah, well, I think Brisbane was close to the start of Adelaide as well. I can't remember how much gap there was between them. But like you said, you could have diversified there.
And this is where a novice can get caught out, or maybe let's say you were with a BA firm, or let's say they were based in Perth through that time. Perth was doing nothing for a very long time. That you could have picked up properties in Perth, but you would have been waiting a long time to get that capital growth, where you could have been in Hobart. You could have been in Melbourne through that period, was having some okay growth at certain times. You could have gone into Brisbane and then jumped into Perth.
Yeah, that's right. It's all about timing.
It's all about timing. And all you can do is look at now.
Yeah, right now, where's the best place for your equity?
All righty. I think the last point I've got on that is, the way we would look at it is, or I would look at it, or both of us would, like state, then you work your way down. So like if I've got one, maybe only a handful of suburbs in, let's say, Darwin, that have good indicators, it doesn't mean that I'd be going there just because of that. I want to see a high volume of markets with good data, because that gives me confidence. Okay, well, if I can get that state right, that's a big tick. And then, or the city, for example, tick. City, yeah. And then you go LGA, tick. So you're trying to put more and more in your favor as you sort of go down that checklist.
Yeah, you get yourself in the ballpark, then you get yourself in the right half of the field, and then you pick which blade of grass you want.
Jeremy, where can listeners go for more resources?
Give us a thumbs up if this is the sort of content that's of interest to you, and there's a share link if you know someone that could benefit from this, and you can subscribe to be notified when we dish out more. That's right. Subscribe, like, and share to the world. Thanks for tuning in, and see you in our next episode. Bye for now, and take care.